Hi everybody, welcome back to the Middle Class Investor. This is Seth Martin. Thanks for joining us again today. Well, today, today April 2nd, the market, the S&P 500 had an all-time closing high record again. And you can see that's the chart we have up right now. And as you can see, it broke out of this this kind of consolidation area right through here. It did pull back to a higher high. Remember we talked about that. In fact, the higher high was we were on this day right here, this white candle day. So the low was kind of already in, and we had a higher high already. A higher low. And we talked about that the higher probability action in the market would be to the upside. Once the market pulls back and makes a higher low, the probability is the market continues the trend. The higher probability is always that the trend continues. Now that does not mean that the trend will continue forever. We all know that doesn't happen. But it just means that once you're in a trend, higher highs, higher lows, and that trend is repeating itself, the probability is that the trend will continue. The market either trends, I mean this is obvious, but it either trends in one direction or the other, or it trades sideways. But it's fairly, if you have higher highs and higher lows, then you know the trend is up. If you have lower highs and lower lows, you know the trend is down. And this would be an example of a sideways trend. So over this time frame, right here, the market was trending sideways. It kind of came up strong, and that's what happens when it moves real strong in one direction or the other. Then you tend to get a little bit of a consolidation before it either rolls over or turns up. But in this case, since the trend was up after the consolidation, the probability is that the trend continues, and that's always the case. Now, we talked about this wedging pattern and how this whole wedging pattern is in itself a consolidation pattern. So, and we talked about how that resolves itself. We'll look at a 5-year chart, weekly chart, and you can see that from the lower bound of this wedge to the upper bound has been narrowing over time, and eventually this will correct itself. And the way these correct themselves, a rising wedge corrects itself to the downside, and I think it's roughly two-thirds of the time. Two-thirds of the time, this will result in a move lower. Now, one note before we move on from this is it could actually come out of the upper bound of this wedge and then maybe roll over. This would be what we call a fake out. The interesting thing about the chart here, what it's telling us is this consolidation, width of this consolidation here is about 40 points. So what this normally means is that when you get a breakout of a consolidation like that, you can usually take this distance and add it to the top here. Now, it doesn't mean that it immediately goes 40 points. In fact, it could actually pull back a little bit here to the 30-day moving average. Not likely the 50, but maybe to the 30-day moving average and a little bit beyond, and then go 40 points. But if it does, it will obviously be above this upper bound here. Now, does that mean that's a breakout? Not really, no. Because this wedging pattern that we show on the 5-year chart, with a very high probability, I don't know, 78% of the time, 80% of the time, resolves itself to the downside. So, that's not the kind of, those aren't the kind of odds you want to fight. So, while we're here, let's look at one of the interesting things that's happening in the market is the S&P is at a new high. But if you go to the Dow, let's zoom in on the Dow. The Dow has not yet made a new high. nor has the NSADAQ. So let's look at the NSADAQ. NSADAQ has not made a new high either. In fact, the momentum, the internal momentum in the market on the NSADAQ is also down. You can kind of see this long move down, and these are the market internals. This is what's happening underneath the price action. Now, all indicators are lagging. They're lagging indicators, so you can't use what's happening here as a leading indicator. Price is the most accurate leading indicator, but you should look at this because this tells us kind of what's happening underneath the surface. So again, the interesting thing here is there's a divergence in the market between the S&P 500, which is the most diverse major index because it represents 500 stocks, and then the NASDAQ composite, it actually represents 2,500 stocks, but the market caps of those stocks are much lower than they are in the S&P 500. So even though it's more diverse, I mean, this is where a lot of tech companies are and things of that nature. So it's not representative, as representative of the economy, I guess is a good way to say it. Nor is the Dow. Let's look at the Dow again, because the Dow is 30 stocks. So, 30 companies is also not representative of the economy. So the S&P 500 is usually considered the boss. Now, usually what you'll see is if the market's going to roll over, you'll see the Dow actually outperforming the NASDAQ, not the S&P 500. So there's kind of some interesting stuff going on here, and who knows what it means. I mean, it may mean nothing, but it's certainly something. It's certainly an observation that is worth making. Let's look at the 10-year Treasury while we're pulling up charts, because one of the things I want to show here is that the 10-year Treasury, after coming up here to a relatively new high of 3%, it pulled back, pretty good move back, and then consolidated like we talked about. Now, this is not a rising wedge. This is just a sideways triangle kind of pattern. Sometimes people call them a pennant. And it's usually a trend continuation pattern. So what does that mean? Well, the trend was up, right? So it pulled back, came into this triangle, and it has broken out to the upside and probably will continue to the upside. But I have my suspicions about how long, because the width of the little triangle here is not very significant, so I'm not sure it's quite enough to break out to the upside and keep going from here. In fact, I think probably what a better plan would be to watch it move up here slightly and then roll back over to the downside. Now, the reason I'm bringing up this plan is because we talked before about how some of you may have bond funds in your IRAs and your 401ks, and in a rising interest rate environment, you do not want to be an owner of bond funds. So it really just kind of makes sense if you think about it. If we're at 50-year low interest rates, then a bond fund is not something you're going to want to own, quote unquote, long term, because the long term rates are at long term lows to kind of beat a dead horse there. So what you want to do is you want to be looking for opportunities to move away from those bond funds. And I think a good opportunity, now look, if this breaks out and makes a new high up here above 3%, then what I just said is wrong, and you probably ought to go ahead and trade those bond funds in and move away. But I think probably what's going to happen here, because this pattern is not that big, this will probably break out, come up in here to just around 3%, maybe a little bit above, and then come back and retest the support before moving significantly higher. And coming back to this support would be a great time to just get out of those bond funds. The other thing I wanted to talk about this week, because I'm sure you're looking at these videos and you're saying, well, what are all these lines and why are they important? So I just want to touch on that real quick. These you see a red and a blue line. These are called moving averages. These happen to be what's called simple moving averages, and they're lines that the market looks at. So there's a 30-day moving average, and then there's a 50-day moving average. You can put all kinds of moving averages up here, but the reason I have these two is the 30 is kind of a short-term to intermediate-term moving average, so people that trade over that time frame. And short-term might be, let's say, 2 weeks, to intermediate might be 3 months, something like that. Maybe not quite that long. Maybe 2 weeks to 6 weeks or something. And then intermediate to long-term might be that might characterize more what the 50-day moving average is, which is the blue line, and that might be more like 1 month to 3 months. So what you'll notice about these moving averages is that the market will come down. It will use the moving averages as support. Now sometimes support is not a hard line, like this line is not a hard line support. Support is an area. So I would consider this right here of the market coming down to the 50-day moving average and using that 50-day moving average as support. Here, there was no support. It just broke right through support. Here, I would consider this 50-day moving average support. So 50-day moving average or support, when I talk about support, we're talking about a zone or an area. We're not talking about a hard number. That's why when I drew this box up here, this is a zone. And the zone starts at around 16,000 on the Dow. Same thing with the resistance. The market has resistance here at 16,615. Now, I don't think this resistance is going to hold. I think the Dow will ultimately make new highs here, but it might not. We need to be prepared for it not to make new highs. The point is, you have a plan. If something doesn't go to what you expect, if it's not moving the way you expect it to move, then you have a plan to deal with that provides some sort of action. You make a decision that provides some sort of action, and that's what's most important. Nobody knows what's going to happen tomorrow. If you got friends coming up to you and saying, "Hey, the market's going up tomorrow or down tomorrow," or go ahead and get out because the market's going down next week, those aren't accurate statements. I have made statements like that myself, but it's not so much a prediction of what's happening tomorrow or next day, but something is going to happen eventually because it just can't sustain itself or whatever. But nobody has a crystal ball. Nobody knows what's going to happen tomorrow. So don't listen to that kind of stuff. Now you can say, you'll hear people on TV, you'll hear people like Peter Schiff, talk about what he thinks is going to happen. Well, he's taken a lot of economic data and he's talking about economics, and I think he's probably right about a lot of that. But that's not tradable information unless you're talking about you have a very long-term horizon. So you could lose a lot of money, I guess is what I'm telling you, if you stayed in that. If you stuck to a plan like that, it could take literally years to unfold, and so that type of information is not useful, generally speaking, in the market. Now, it may be useful in terms of, hey, I'm going to watch out for this, and if this starts to happen, then I'm going to take action. But day to day, month to month, week to week, quarter to quarter, year to year, that's not very useful. Speaking of Peter Schiff, let's go ahead and look at the gold and silver index real quick while we're here. So, gold has been selling off for, most of last year, and but all of this year it actually has been up. So this is the beginning of this year, and it's been up and up. And only recently has pulled back. Now it pulled back through the 50-day and the 30-day moving average. Looks like it's trying to make a little bottom here and maybe move higher. It's hard to say. Gold is it's a pretty emotional kind of trade right now, and there's a lot of activity around the world that's driving the price of gold. So gold is not so much an investment as it's just a store of money. So if you feel like the government is stealing your money by printing it, then you want to have a little bit of gold. But I think if you're going to buy gold, it's probably, unless you're just going to trade week to week or something, if you're going to buy gold, it'd be better for you to just go buy gold coins or gold bullion, things like that. That's really about it this week. I mean, the market's up, so hopefully you're making money, and you're feeling good about where things are headed. Just keep in mind we have a divergence. These things tend to resolve themselves one way or the other. Either the NSADAQ and the Dow are going to catch up, or the S&P is going to get pulled down. I mean, that's the way it works. So look for the NSADAQ to break out of this. Now, again, it might not break out right away. It may pull back a little bit because we've had a pretty good run here. Of the last week. So the market zigzags, right? You get 4 or 5 days up and 2 or 3 days pull back, and so on and so forth. So, but look for either the NSADAQ and the Dow to go to new highs, or for the S&P 500 to pull back and have these highs hold. So we don't know which way that's going to work, but it will resolve itself one way or the other. All right, that's it this week for the Middle Class Investor. Thank you guys for coming and visiting the channel. I hope this is helpful. If there are any topics that you want to discuss in this forum, please fill out the comments section and give me some feedback about what you'd like to talk about. Sometimes the market's kind of, there's not a whole lot going on. They're just trending, or they're range bound, and so we're talking about them, but there's no action to take. There's no decision to make. So if you have other topics that you want to talk about, we can certainly discuss during these videos. All right, well, until next time, thank you for visiting the Middle Class Investor.